Is it possible to increase the value of your business by 20 to 50%? The answer is yes. And on today's show, I'm joined by my fellow growth thinker, Jeff Jones, the Vice President of Growthink Capital. We're going to talk about what it takes for you to increase the value of your business. You're not going to want to miss this value-packed podcast. Jeff, welcome to the show.
Thanks, Tim. Thanks for having me.
So I have a big question for you. Is it possible to unlock hidden value inside of a business to increase their selling price by 20 to 50%?
Absolutely.
Well, today we're going to talk about that. I'm excited to learn what it takes to increase the value, because you have to imagine, if you're a business owner, you get approached, someone wants to buy your business, you're probably thinking, well, first of all, you may or may not know what your business is worth. And if that's the case, call us. We can have that conversation.
Yeah.
But most people might have a sense, especially if they've been running their business for any period of time. They more or less have a sense of what the business may be worth. But when they start getting real offers, then they naturally go through the process of saying, can I get 20% more? Can I get 50% more? Hey, I mean, maybe doubling it might seem a bit extreme, but getting 10, 20, 30, 40% more, that's within the realm of possibility. So what I thought we would do on this chat is just talk about what they can do to increase the value. I know we were talking the other day about recurring revenue as being one of the central focus points to increase the value. What's your take on that?
Yeah, I think that the recurring revenue model wins the day in terms of the ability to maximize value of any business. That's been a trend that's been kind of moving along for the last decade or so, is why people see software companies selling for such high multiples and such premiums. But yeah, anytime you can create consistency around your revenue stream, albeit a pure SaaS play, subscriptions, long-term contracts, the buyers see that as a business that's more stable, more predictable, and they value it higher. It's just the way it is. And so if there are ways to be able to create recurring revenue in your business, we highly recommend you do so. If your business isn't a pure play type of recurring revenue business, then try to demonstrate a strong cohort of repeat customers, customer retention, a higher value add product service, things of that nature, to be able to demonstrate that loyalty and that recurring type of sale across all product categories. But for the most part, buyers are always most concerned with the type of revenue model, and at the top of the pyramid is that recurring revenue opportunity.
Yeah, it's kind of like the holy grail, especially in this fast-moving SaaS environment. But a lot of the folks that we deal with are running older businesses, legacy businesses, industrial manufacturing. That's not to say that they don't have good repeat business. They may not be thinking about it in the same way that, let's say, a software company may be looking at it. Maybe they're just creating parts or widgets of things of that nature. So what would you recommend to the business owner that wants to work on their recurring revenue, but their business model may not exactly be perfectly suited to have this, subscription style model?
Yeah, I think it comes back to trying to create some consistency within those customer channels, within the revenue streams in general. And so, again, those types of examples that you mentioned, Tim, oftentimes you'll have customers that have long-term contracts or short-term contracts, and that's something that you can look to extend to create some continuity and consistency in the business. Oftentimes you have the same customers coming back and doing repeat purchases in those situations. So being able to kind of track that and demonstrate that over time will help. Again, it's not the pure definition of recurring revenue, but the reoccurring theme is also strongly valued versus, let's say, a one-time unit sale. So again, showing long-term customer track record, retention, loyalty around that, longer-term contracts. There are ways, of course, to try to maybe elongate your monetization schedules in terms of a unit sale that could, essentially be financed over time as well. But there are definitely ways to tweak what you're doing to provide you with more of a, I guess, premium value on those streams.
Yeah, and the logical reason for this is predictability, de-risking, correct?
Yes, it's much easier to get comfortable with the business, someone looking from the outside in, when they can see that recurring schedule, right? So predictability, stability, continuity, consistency, it's all de-risking. And if a buyer can de-risk your business considerably, get very comfortable with the state. Also, the more recurring or reoccurring themes around the revenue model, the easier it is to kind of predict what's
Mm-hmm.
going to happen in the future. And a big part of your valuation, which people don't really sometimes understand, it's not just what you've done over the last 3 years, it's where the business could go over the next 2, 3, 4, 5 years in the future and how that relates potentially to the buyer. So to be able to demonstrate a consistent, solid stream of revenues and be able to forecast that in the future is going to add value to the business.
So the as we kind of move out of recurring revenue, that moves us right into consistency of
Yeah,
growth and profitability. Because if you have good recurring revenue and good predictability, then that should also lead into a very consistent business that's predictable and profitable.
indeed.
Yeah.
And growth and profitability are always the most important fundamental in the business. So getting the financials in a place where people see a growth trend, growth potential, and responsible growth at that, with some bottom line to show for it. So that's always going to be the case. Doesn't matter what industry you're in. That growth and profitability metric is key. And here at Growthink, we kind of I've coined the term here, the rule of 20, where if you can show consistent growth, and again, if you're a more mature company and you're not early stage seeking 10x growth year over year, getting to a 10-20% year over year growth trend on that top line revenue is what everybody looks for. And then ensuring that growth is done responsibly, so you can deliver margin and deliver what we call EBITDA, which is essentially operating income, which would be 20% of that revenue. So 20% growth, 20% EBITDA margin. If you can kind of pay attention to that, focus on those key metrics within the financials, you're going to get a lot of people to the table. It always comes down to the basic fundamentals of financial performance. So, over years, this has changed the sentiment in the market. A lot of people see these crazy valuations in tech and software, and it was kind of a growth at all costs mentality a few years back. Money funneling into these companies to build market share. That has somewhat pivoted over the last 18 months or so to really focus on profitability and kind of normalization of the business. And so, that's kind of what we're preaching to our clients as well, making sure that is the core focus going forward with the business.
So if you have good customer diversification,
Yes.
you have good revenue predictability, you're trending relatively safely, and the buyer can come in and say, okay, I'm de-risking because I can project out 4 or 5 years and I know more or less what this is going to look like. I can see where we can infuse capital to help this thing scale and grow. If all those things are working in your favor, chances are you have a pretty good market position. And that
Very.
leads us to this brand value, because there's plenty of businesses out there that are well positioned in the market, but you may or may not know them. And there's plenty of other businesses out there that have these wonderful brands and they have this awesome perception, but they may also be losing money. It's just they spend a whole bunch of time on brand and not enough on profit. Right?
Yeah.
So, what is your take on how having a strong brand can also help increase your valuation?
Well, as you said before, the holy grail is to have all of these boxes checked: strong financial performance, and of course, brand value. That helps. There are a few things that can overcome maybe not squeaky clean financial performance, and one of these things is to have a great brand. And quite frankly, it depends on the buyer here in the eye of the beholder. But at times, brand value can be a priceless asset. A buyer sees that business and that brand, whether that brand reflects fantastic product or service quality, customer retention and loyalty, competitive advantages, right? Recognizable brands. They see this as an asset they're acquiring, not just a company, but a trusted, reputable name with quality service and products, built-in demand, and there is a premium value attached to that. So getting comfortable, you say de-risking. If I know I'm buying an asset that, again, resonates in the marketplace for all of these things, that will drive value 100%. Now, this is less of a formulaic approach
Mm-hmm.
to what we talked about in terms of the financials. Yeah, it's more qualitative. It's kind of how it's based on the buyer, how the synergies will happen. But it only enhances the value of the company. I've seen this personally happen where the brand is so strong and the buyer is so enamored with it in the market that that valuation could increase 25 to 100% based on someone falling in love with that specific asset. So, brand value, develop a clear identity, dominate your niche, leverage partnerships, be a thought leader, create compelling content, access, omni-channel type of strategies to move that brand forward, and it will pay off.
Yeah, I've also seen plenty of times where the niche itself, there's a certain vernacular, there's certain terminology, there's certain
Yeah.
layers. It's not always so easy to penetrate a niche. So the big dogs understand, well, we just buy our way in. And if we have to pay a premium to buy our way into the niche versus trying to build it from scratch and then work our way up to compete, it's a lot easier, especially when we have capital to throw around. And a financial buyer, that's more or less what they're thinking, correct?
Yeah, the buy versus build strategy, again, depending on the buyer profile, that of course, when you have a ready-made asset that you can plug and play, there's value in it for sure versus trying to build it on your own. So that's always the discussion with the different buyer profiles in the market. Absolutely.
Okay, well, let's turn the page here a little bit and talk about owner dependency, those that
Yeah.
work on versus those that work in the business. And it's the tricky blend and the balance of running any business. Anyone who's ever started one knows it. But why is it so important and how does it help the valuation? The business isn't so dependent on the owner.
Yeah. Well, I mean, you nailed it. I think that there's going to be more value when a business owner is focused on working on the business versus in the business. And so you want to make yourself as an owner operator, um, non-essential. Okay.
Right.
And that's from the day-to-day operations to sales to IP creation, just the daily task of running the operation. Your focus needs to be strategy, vision, and just kind of, guiding the ship type of scenario. Why that's important: buyers come in, they want continuity, they want the ability to access a management team that is well versed, well skilled, is functioned into operating that company, is aligned on the growth strategy and what you're trying to accomplish. If it's all dependent on you as one person, then what's going to happen is you're going to get locked into that business for the long term. If I'm buying your company and you are the key asset to everything, I'm buying you,
Mm-hmm.
right? So good luck getting out of that situation. Also, that impacts value extraordinarily. Again, if I'm putting all my eggs in one basket with one person, it's going to be worth less than if I actually had infrastructure, right? If I had a leadership team that could drive the ship forward, again, de-risks, diversifies the aspects of the business, that's worth more. So you want to try to create a business that can potentially run on autopilot, develop a strong management team that can execute effectively without you, understands the business, is aligned on exactly what you're trying to do in the next few years, automate the company as much as possible, standard operating procedures within the business, outsourcing core elements like customer service, accounting, things of that nature. If you don't do this, you're going to have a problem. Does that mean you can't sell the company? No, of course not. But it means if the business is dependent on you, therefore any buyer coming in will be as well. And the transaction will get tied to your performance
Mm-hmm.
and your potential longevity within that business. And that's not necessarily what you want if you're looking to exit. So that does impact valuation. It impacts transaction structure and deal structure, which gets very complicated with incentives around earnouts and equity carries and such. And so, talked to a guy earlier today, actually, a business owner who focused all his time on sales for his business. He's got a management team, but all of the sales dependency within the business was dependent on him, and that's a problem, right? So these kinds of things you got to think about planning ahead. You can't just beef up a management team and reduce your dependency on the business in one day. This is going to take time to prepare, and I guarantee you buyers will know if the business is well prepared for that transition, and that transition can come with continuity. And if it does, again, it will instantaneously increase your value.
It is my professional opinion that most business owners, the place where they're most essential is in business development
Yeah.
because when they started their business, it was them starting a business and they had to go do everything. And the last hat that they typically remove is sales and business development, partnership development, the management of relationships. That is really the last thing that they let go of. Have you ever seen a situation where a deal didn't occur because the owner had some maybe too much identity tied into the deal? Like, what do you see out there in that regard?
Of course, that happens. It happens all the time. When you get into due diligence conversations with any buyer, this is going to be uncovered. And to your point, oftentimes that owner operator is locked into relationships within that customer base, and that customer base kind of demands it. So again, you have to take a step back and start inserting others into that relationship, into those channels early and often. So by the time you're able to exit, it's you can detach yourself from it. But of course, I mean, if buyers recognize this very quickly, there's really no value if you can't maintain customer relationships, if you can't create a path for customer acquisition and growth, and if it's dependent on you and you alone, there's no exit. You
Right.
could still sell your company, and that's fine, and you can create liquidity, and that's great. This happens all the time, but you're going to be counted on now to move that thing forward over the next 3 to 5 years minimum. And if that's something you're open to do and you're long for it, great. But there's still going to be an expectation for you to diversify those sales responsibilities, that customer base, with other people that can help.
Yeah, that's very sobering information. So that then moves us into the business owner that is always mindful of keeping their house in order. So let's talk
Yeah.
about the importance of having your house in order and how that having a house not in order can slow things down or potentially kill a deal.
Yeah, I think that you have a spectrum here, but the ideal situation for buyers, both strategic and financial in the market, is to approach a seller who essentially is running their business like it's a public company, right?
Right.
Full transparency, corporate governance, standards around ethics management, everything. Financials are crisply clean,
Right.
right?
Yeah.
And everything is above board and beautiful, right? So that's the ideal scenario. That's usually never the case.
Right.
There are always gaps or skeletons in the closets or some issue that are going to be uncovered. So with that said, the due diligence cycles of 2025 and beyond have gotten intense and rigorous and institutional grade. If you're a $10 million business or if you're a $100 million business, it's the same thing, which is kind of mind boggling to think about. But in my business, when we are constantly working with buyers and sellers and kind of being the guide to this process, you see these due diligence cycles come and they're nuts. And so the best thing you can do, again, this requires a little planning, but first and foremost, have those financials in order. The last 3 to 4 years, clean statements, whether they're reviewed or audited or not, but have them clean and then have a nice forecast going forward that can be tracked and verified. Very, very important. Things like looking at owner discretionary items or expenses or one-time expenses in capital expenditures, for example. Those things benefit you because they are going to be added back to your operating income, which valuation will be based on. And so we always want to be tracking those on a year-to-year basis. They're called add backs or adjustments. And that's something that a lot of people don't think about and don't account for. And this is something that can be done very easily over time. You want to be able to show a track record of that. Things like resolving legal issues, huge deal, right? And I think this is an obvious one, but you'd be surprised how many situations we encounter with companies looking to exit or sell, and they have outstanding legal issues that are for sure going to side rail a deal for sure every time. If these things are being resolved, or you can show proof of that or are resolved, that's okay. But make sure those are taken care of and attack those issues. Something too that people aren't, and I mentioned this earlier, a lot of the value of the business is based on what the future will hold for it, not just historically what you've done, but what you can do going forward. And so be able to define and showcase a growth roadmap, right? Delivering that to the buyer. Be ready to say, we know what our growth strategy is. Here's what we would do. Here's what we would do with you, buyer, going forward. And that's going to help the conversation move much more swiftly. And then finally, data room type of organization of all these materials. from financials to operations, HR, legal, things. If it's like an industrial type of company, property, plant, and equipment, things of that nature. So it really can get in depth. I'll give you an example. We had an opportunity in a deal we worked on last year. There were 1,500 files in the data room. Okay. And that is, again, requested by the buy side, who come with different outside parties to evaluate your business, and really kind of going through with a fine tooth comb every element of it. So the more you can prepare and get organized, this actually adds value to the transaction. Why? Because a buyer is more likely to acquire a company that has full transparency, is clean, there are premiums attached to it, but most importantly, they're less likely to negotiate and retrade you during the process. And of course, the likelihood of closing the transaction is much higher, exponentially higher, versus encountering a bunch of things they weren't expecting, or due diligence cycles and requests taking forever to fulfill or satisfy.
What's the wildest due diligence request you've seen? Because a lot of times we just think the basics, right? But
Yeah.
when you've been in the game for a while, you're like, wow, I saw something that I had never seen, or just really preparing the business owners for things that are going to come at them
Yeah.
fast
Yeah.
in
I
the
think
process.
it comes back to the owner discretionary stuff,
Hmm.
where, listen, we own businesses and there are financial benefits and tax benefits to do so in America, and that's awesome. That's great. That's why you do it. But going back to, like, I've seen, um, owners bake expenses into their companies, perfectly legal to do so. But I've seen a due diligence uh, assignment come in and track expenses that had to do with someone's dog, for example, right? And so the nitty gritty of that, and again, having these things prepared, are very, very important. It changes the game at the end of the day to get the deal done.
Yeah, I love it. So getting prepared, we're talking about having clean due diligence, clean files, clean folders, legal compliance, all that aspect tight.
Yeah.
There's also a component of who's going to buy this business once all that's in place. So once we have everything nice and tidy, we're feeling pretty good about it. We have, we have this recurring revenue aspect. Our brand is tight. All this stuff is dialed. When we're ready to go into market, how do we start preparing as the business owner? How do we research who would be a good person to buy our business? Like, what mindset should we put ourselves in as business owners in that regard?
I think now more than ever, too, a lot of business owners running nice companies are getting solicited
Mm-hmm.
preemptively in the process by buyers, strategic buyers, other companies in your space, maybe reaching out, financial buyers like private equity funds. This is happening now all the time. And so it's likely that you, as an owner operator, have already had some of these discussions, right? And so we recommend that you take advantage of all of those, right? Get educated, learn what these buyers potentially are looking for and why, and maybe build the business towards those goals.
So are you
But
recommending jumping on some of those calls just to hear people out?
absolutely, I talk to clients that get these calls once a week,
Mm.
right? Now, over time, do you take every single one? Of course not. But the idea is to get a sense of how the market views the company. What's important to the set of buyers out there that you should be addressing, right? Why? Because that increases value. That makes the business more attractive. It hits home and allows you to run a process to create a marketplace for the business, and competitive process to get the best deal. Now, with that said, you need to know what drives value for your company. So get informed, know the industry, know your competitors, who are the key stakeholders, right? Start developing maybe some relationships with these people over time. You'll probably think alike. You'll gain insight as to, again, what those value drivers are for the company. What do you want out of a deal? What do you want out of a partner? And developing some relationships firsthand allows you to get on the radar, identifying who the right fits might be. Again, developing a relationship over the time and understanding the pros and cons of what the best buyer is for you. And also, again, what those value drivers are for your business. So, like everything else we've talked about, just create expectations that are reasonable, get out there, understand what's going on, and the outcomes will more align with those expectations versus if you're going to it, eyes wide shut, if you will.
Right.
Um, and this is a lot of what we do with our clients, or even prospective clients over time, is to help them understand where they fit in the marketplace, what the buyer set looks for, and how to drive value based on that.
Well, that was going to be my next question, so you jumped ahead here. But yeah, talking very specifically, I want to get into a little bit of detail here about how Growthink supports a client in the process from end to end. Maybe
Yeah.
in a few minutes there, but let's use an avatar. So if you're out there in the audience and you're hearing this and you own a business and you're getting these phone calls, you're starting to pick up calls from various financial buyers, and maybe you had a few calls and you're starting to ask these same questions, and Jeff Jones is inside of your head and you're hearing him say everything. You're like, yeah, that sounds about right. When you reach out to Growthink, what is the process going to be for us, Jeff?
Yeah. Well, the underlying or the common denominator of all of this, Tim, is to maximize value at the end of the day.
Yes.
And I know that some people aren't just about a number. Some people, they value legacy, some succession, their people, whatever they've built. It's their baby over 30 years, right? It's a family thing, whatever. Great, but kind of have a plan. So the first step we do is to talk about the situation today and talk about what that ideal situation is after,
Mm-hmm.
right? And so have a plan. And that could be something that you might be thinking to sell your business in 3 to 6 months. Fine. You still need to have that conversation. Or it could be, 2 to 3 years. Happens all the time. And so have that conversation, get it out in the open, start formulating kind of the ideal scenario that you would envision for yourself, your family, and the business at the end of all this. That's step one. Step two, I'll go back to what I just said. We got to get informed, right? You have to understand what's going on in your space, which likely you do. Again, from an industry perspective, from the competitive perspective, and also who's buying companies in your space, who are the big buyers, financial, strategic, helping them understand where they fit, and again, what drives value. That's definitely step two. Step three is to identify the right time and work towards that plan to maximize value and do all these things we discussed today. And then from there, if we decide to all of us engage and run a process, then from there it's okay, we got to build the book, build the story. We want to create a scenario for the company in the marketplace that is, of course, showcasing what the company has done and what it's going to do. So likely that requires building, a narrative around that, building some financial forecasts, right? From there, it's identifying the right buyer set with the client. And then it's the fun part. You go out and you execute. Outreach to the market, having a lot of conversations with all sorts of buyers to get a feel for who's right and who's wrong, and try to create a small cohort of interested parties that helps us create kind of a competitive process. So there's a lot of people attracted and interested in what you're doing. And then from there, kind of run a process to get through some preliminary due diligence offers. Once you decide on the right buyer, then the formal due diligence will take place, which we will lead and facilitate throughout to get to a final close. That process can take months, sometimes over a year, sometimes much less. It really depends on how prepared we are, I guess, how active the market is, and the right buyer fit that we're looking for.
So end to end, Growthink can support with pretty much everything from helping me get my house in order to helping me tell a story to help me wrap my head around potentially the existential big questions of what does this next chapter look like? Is there something beyond selling the business? Can Growthink help me even after I've sold the business? Is
Sure.
there some infrastructure there?
Yes. We again, part of the planning process is to understand for you personally and your family what that looks like post transaction. Again, and that there's financial goals to consider as well. We've actually developed a platform, Growthink Investment Management, which is essentially kind of a virtual family office for owner operators for this particular reason. Oftentimes, when we encounter companies and owner operators that are looking to sell, they haven't thought about what's next. Not what am I going to do with my life, but more about financial security and wealth creation. And that includes not just what the proceeds of the sale, which you have to think about tax complications, right? You have to think about succession planning, legal ramifications of that. But what does that look like net going forward? And how do I manage that going forward if this is my last big payday? So
Right.
that we actually integrated a practice area to create kind of more of a full platform to address those needs as well.
Last question. What can't Growthink do?
Well, you know, we are not here to do what you do best, and that is to operate your company. We are here to guide you, to prepare you and your business for the ultimate event, right? So if you know you're getting it 80% of the way there, we're going to get it 100% of the way there at the end of the day. Our expertise is how to position a business in the market to maximize value and go out and execute and get it done. With that said, Tim, this is all based on expectations, right? Buyer, seller, market expectations. That's really important for us to be able to manage, right? And two, it's putting a plan in place, going out and execute, being persistent, aligning with those expectations, and getting something done.
Well, there you have it, folks. You heard it here from Jeff Jones himself. We're going to put all the contact information down below. If you do have a business and you are thinking about selling it, please contact us, reach out, schedule a free consultation, hop on the line with one of our growth thinkers, and we'll walk you through the process. Thanks very much.